Hey, welcome to Dow Stock Talk, where I talk about topics relating to investing and finance, but more specifically, the stock market. Now, in this video, I'll be going over different types of stocks, so make sure you stay tuned. Now, before we get started, make sure you smash that like button. And if you're new to my channel, make sure you subscribe and hit the notification bell because it'll alert you whenever I make new videos. And by the way, I try to post at least once a week. All right. So first up, we have your blue chip stocks. Your blue chip stocks is solid companies that have been around for a while that has normally a good balance sheet and consistently produce positive earnings. So those are the stocks that's probably going to be not as volatile. They're going to be your stocks like your household names like Walmart, McDonald's, Johnson & Johnson, Visa, like companies like that. Everyone probably knows about them. They've been around for so long, so that's why they call it blue chip stocks. And a lot of times long-term investors like this because they see consistent earnings as well as a healthy, slow, but steady growth rate. So that is another thing. You got blue chip stocks as one type of investment. I wonder, will it rain tomorrow? Oh, the next type of stocks we have are speculative stocks. So speculative stocks are normally startups who are in companies that have untested products or in emerging markets that people don't really know too much about, have very little financial history, so it's kind of hard to place big bets on them. But the good thing about speculative stocks is if you're right, if you do pick a winner stock, you can get huge gains. But a lot of times with speculative stocks, it's very based on beliefs or what people think or what people hope or what people believe to happen. So these are why they call speculative, because they are risky, and a lot of speculative stocks does not meet the expectations, but the one who does, that's a winner. So speculative stocks is another one. And that leads me into another one. So different type of speculative stocks, what you consider is penny stock. So penny stocks are, I just thought originally when I heard about stocks that were a penny. But by definition, stocks under $5, normally very small cap. A lot of times with penny stocks, they can definitely be a little risky, not only because they're small, but a lot of times people like pump and dump these, like very speculative, so they just have short position. So if you were investing in penny stocks and you were investing for a long time, a lot of times a lot of penny stocks don't do too well. It's kind of like a short spurt. And you have some penny stocks that does well, but the majority of them, as far as the success of the business, a lot of them end up failing. And that's just reality. But penny stocks is a type of stock. So another type of stocks are secular stocks. Secular stocks they kind of relate heavily based off of how the economy doing. So if the economy is doing well, these stocks are doing pretty well. If the economy is doing not so well, these companies are probably not doing as well either. So secular stocks, they kind of heavily depend on the economy, how the confidence the economy is going, whether it's good or bad. So secular stocks has a direct correlation to the economic conditions. Another type of stocks are called defensive stocks. So defensive stocks is regardless of how the economy is doing, whether good or bad, defensive stocks normally do well either way. A lot of times defensive stocks are things that you need regardless if the economy is doing good or bad. So a lot of times some defensive stocks are in like healthcare and utilities, stuff that you're going to need all the time, and basic consumer goods, things that you're going to probably need anyway. So those are like the defensive stocks. Investors normally shy towards defensive stocks when of times of uncertainty. So that is a different type, defensive stocks. Okay, so next up we have income stocks. So income stocks are companies that normally pay higher dividends. And you have some companies that may pay a lower dividend, but they slowly increase it over time. In my opinion, those are the best ones. Now, the thing about with the dividend stocks, you have to be a little careful because sometimes companies will end up increasing their dividend because they're not doing so well and their company is actually not doing as good. So the stock prices end up going down and you're just seeing the dividend actually going up. So that's something you might want to pay attention to if you were investing in income stocks. So make sure you look at companies with consistent track record, great dividend payout, great performance over a good period of time, and income stocks can produce a good amount of money. All right, so the next type of stocks we have are value stocks. So value stocks are cheap stocks compared to the company's previous performance and the amount of assets they have. So a lot of times with value investors, they go after good companies that are at a cheap price relative to the productivity of the company itself and not necessarily the share price. But it is a cheap price compared to how profitability the company is and the amount of assets that they have. Try not to get you too confused, but I definitely wanted to mention that because that is important. And if you wanted to know a little bit more about value investing, just know that Warren Buffett is normally the founding fathers, and the key aspect of it is intrinsic value. Knowing how to know the intrinsic value, because if it's above the intrinsic value, it's overvalued, and if it's under intrinsic value, it means that the stock is undervalued. I just want to throw that out there just in case you were always curious how value investors know when to buy and sell stocks. Okay, next up, we have growth. So growth stocks is a lot of times the crowd favorite because these are companies who have huge cash flows that whenever they have profits, they reinvest almost all of it back into their business so that they can have rapid growth, rapid expansion, and they can have much higher earnings. So typically speaking, if you were just trying to give you a little bit more insight, if the P over E ratio is high, it's a good chance that it could be a growth stocks, because whenever investors is paying a higher amount now, it's because they have high expectations in the future. By the way, a lot of growth stocks is like tech stocks you can think of, like the Amazon, Dropbox, any type of company who's trying to expand and grow pretty quickly, you can categorize them as growth stocks. And that concludes my video. Let me know in the comments below which type of stocks are your favorite. And in my next video, I'll be going over common mistakes that beginners make in the stock market.